The moment you add a second name to your bank account, you do not own half of that money. You own all of it. And so do they. All of it. Either one of you can walk in tomorrow and take every dollar, and the bank does not have to call the other one to ask. That is not a loophole. That is how a joint account is built. And after 65, that single signature is the most expensive one most people ever sign. Almost nobody adds a name for a bad reason. You add your daughter because you had a scare in the hospital and someone needs to pay the electric bill if it happens again. You add your husband because after 40 years, it feels strange not to. You add the neighbor who drives you to your appointments because she is the one who is actually there. Every one of those reasons is decent, and every one of them can end with your money somewhere you never intended. So today, 3 people to think very hard about before you put their name on your account. What actually happens in each case? With the states named, so you can check your own. One federal protection that almost nobody knows exists. And at the end, 3 phone calls that solve the same problem without handing anyone ownership of a dollar. Start with the most common one by far, the adult child. Here is what most people believe is happening. You are giving your son permission to help. Here is what is actually happening. You are giving your son ownership. Those are not the same thing, and the law only recognizes the second one. Once his name is on that account, the money is legally his too, which means it now stands in the same room as everything his life is exposed to. If he is sued and loses, that account can be reached. If he owes back taxes, it can be reached. If he files for bankruptcy, it gets examined. And before you decide this does not apply to your family, look at the scale of it. The Urban Institute found that roughly 77 million Americans, about 35% of adults with a credit file, have a debt in collections. That is more than 1 in 3. That is not a statistic about irresponsible people. It is medical bills, utility bills, a small business that had a bad year. Your son does not have to be reckless to end up in that group. He only has to be ordinary, and ordinary is exactly what most of our children are. How much a creditor can actually take depends on which state you are in, and the difference is not small. In Ohio, West Virginia, and Michigan, a creditor can go after the entire balance. In many other states, they are limited to half. And in roughly 25 states, married couples get a stronger protection called tenancy by the entirety, where a creditor of only one spouse cannot reach the account at all. That protection exists for spouses only. It does not exist between a parent and a child, no matter how close you are. Now here is the mechanic that catches people. The bank does not investigate. When the garnishment order arrives, the bank does not ask whose money it is. It freezes the account and waits for the court to sort it out later. And there is a category of creditor that skips the lawsuit entirely. A private creditor has to sue first, win a judgment, and then get a court order. The Internal Revenue Service and some state tax agencies do not. They can move straight to an administrative levy without ever going to court and without ever getting a judgment against anyone. Now the part that almost nobody knows, and it is the one piece of good news in this whole video. There is a federal rule that protects you automatically, and you do not have to ask for it. It is called 31 CFR Part 212, issued jointly by the Treasury Department, Social Security, Veterans Affairs, the Railroad Retirement Board, and the Office of Personnel Management. Here is what it does. When your bank receives a garnishment order, it is required to look back 2 months and add up every federal benefit payment that was directly deposited into that account. Social Security, supplemental security income, VA benefits, railroad retirement, civil service and federal employee retirement. Whatever that 2-month total comes to, the bank must set aside as a protected amount that stays available to you. It cannot be frozen. It cannot be handed to the creditor. And the bank is not allowed to charge you a garnishment fee against it. The rule also forbids the bank from automatically freezing the whole account. It has to do that account review within 2 business days and then send you a notice explaining what it protected and what it did not. But read the limits carefully because they matter. The rule protects 2 months of benefit deposits, not your whole balance. Anything above that is exposed. And it does not apply at all when the garnishment comes from the federal government itself or from a state child support agency. In those cases, the protection is switched off. So it is a floor, not a shield. It keeps the lights on. It does not save your savings. For that, you need the other defense, and it has a name: traceable contribution. If you can prove that every dollar came from you, a court can rule the funds are yours. There is real case law behind this. In Florida, a 1984 appellate decision called Antuna versus Dawson established that property not actually and in good conscience owned by the debtor cannot be taken by a judgment creditor. Courts still cite it today. A later decision from the same court went further. When more than one name is on the account and a third party claims the money, the burden of proof falls on the creditor. The creditor has to prove the funds belong to the debtor. You do not have to prove they belong to you. But that defense has a clock on it, and this is where people lose money they were legally entitled to keep. You have to file what is called a claim of exemption, and the window is short. In California, it is 15 days from the notice of levy, or 20 if you were served by mail. Other states set their own deadlines, and some are tighter. Miss it, and money that was protected can be handed over anyway. Then there's divorce. If your son divorces, an account with his name on it shows up on financial disclosure and gets examined like any other asset. And one more that catches families completely off guard. If you ever need nursing home care and apply for Medicaid, the program reviews 60 months of your financial history, 5 full years. That is the rule in 49 states and the District of Columbia. California runs on its own timeline, and its rules changed twice recently. So if you are in California, that number is different, and you need to ask specifically. Every transfer in and out of a jointly owned account during those 5 years gets reviewed. Withdrawals your son made, even ones he made for you, with your blessing, can be questioned as transfers of your assets and create a penalty period. Months of ineligibility at exactly the moment you need coverage. Now the second person, a new spouse or new partner. Most joint accounts carry right of survivorship. When one owner dies, the whole balance goes to the other owner immediately. Not through your will, not through your estate. By operation of law, that same day. So you have a will dividing your account among your 3 children, and a joint account with your new spouse. When you die, the will does not touch that account. Your children can read that will out loud in a lawyer's office, and it changes nothing. And do not assume you know which kind you have. In 2006, the Florida Supreme Court made this explicit in a case called Beal Bank. The account agreement controls. Whatever the paperwork says is what happens, regardless of what you and your spouse meant that day at the counter. There is also a second form, called tenants in common, where each owner's share goes to their own estate instead of to the survivor. Same account, same bank, completely different outcome. And if you live in one of 9 community property states, your account may be titled as community property rather than survivorship. Those states are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. In those states, only half the account may pass to you automatically. The other half can be treated as part of the estate. One more thing worth knowing before we move on, because it surprises people. Adding a name to your account is not by itself a taxable gift. The Treasury treats it as an incomplete gift because you can still withdraw every dollar you put in. The gift completes the moment the other person withdraws money for their own use. For 2026, the annual exclusion is $19,000 per recipient. Above that, you have to file a gift tax return, Form 709, even when no tax is owed. And here is the trap. If you ever take your own name off and leave the account solely in theirs, the entire remaining balance becomes a completed gift that day. Now the third person, and this one does the most financial damage. The person who helps you, the caregiver, the neighbor who drives you to dialysis, the friend from church who started picking up groceries when your knee went. Here is the number that should stop you. The Consumer Financial Protection Bureau studied tens of thousands of these cases. When the older adult did not know the person who took the money, the average loss was about $17,000. When they did know them, about $50,000. 3 times the damage. Not from the stranger on the phone, from the person with access. And this is not a small problem. In one 12-month period, American financial institutions filed more than 155,000 reports of suspected elder financial exploitation, covering roughly $27 billion in suspicious activity. The reason losses run higher when you know the person is simple. Access lasts longer and nobody questions it. And if their name is on the account as an owner, there is no theft to report. Because legally, they withdrew their own money. You can close the account. Getting the money back is a different road and a much longer one. The people most likely to need help are the people least likely to have anyone double-checking. That is not a reason to refuse help. It is a reason to give access without giving ownership. Picture how this usually happens. You are 68. Your daughter lives 2 states away. After you fall in the kitchen one winter, you have the conversation every family has. You go to the bank together. You add her name. It takes 11 minutes and it feels like relief. For 2 years, nothing happens. Then someone sues her business and your account appears in discovery. Nobody did anything wrong. So here is what to do. 3 calls this week. 1. Call your bank. Ask what ownership category each account is registered under and whether it carries right of survivorship. Write down 3 things for every account. Whose names are on it, the ownership type, and whether a beneficiary is listed. 2. Ask about adding a payable on death beneficiary. It names who receives the account when you die and gives that person no ownership and no access while you are alive. Usually one form, usually free. 3. If you need help now, ask what gives access without ownership. Some banks call it a convenience signer. A durable power of attorney does something similar, and it legally requires the person to act in your interest. Ask by name and have a lawyer draw the power. One last thing in your favor. FDIC insurance is $250,000 per co-owner per bank. On an account with 2 owners, that is $500,000 in coverage. Every figure here was checked against the official source on the date shown on screen. State rules differ and they change, so confirm your own situation with your bank directly. If this made you think of someone, send it to them today. That is the one thing that actually helps. And if this was useful, hit the like button and subscribe. It is how these reach the people who need them. One question for the comments. Is there a second name on your bank account right now? Just yes or no. I read them. New breakdowns for American seniors every Tuesday and Friday. This is the last dollar. Make yours count.